Of all the questions that we get as financial planners, myself and my team, taxes and retirement, by far the most common category of questions is in the area of investments and what is the stock market doing. I've got the 3 most common investment questions we're getting right now and how I would answer them. That and more coming up. It's very common to run into someone at church or at the supermarket or out there with friends. And of course, we get past a little bit of pleasantries. And then there's the question, hey, what do you think about the stock market? Hey, what do you think about this? This just comes with the territory. Imagine being a doctor, or if you are, hey, can you take a look at this? I'd rather have the questions about what's the market doing or something financial than say, hey, does this look strange to you? But yeah, those questions come up all the time. And because we do comprehensive financial planning, these questions can range from tax planning issues to politics and to a variety of different things. But of all of the categories, like where you could bucket or kind of categorize these questions, by far the most common category of questions is in the area of the investment world or in the stock market. I don't know when you're consuming this. I'm recording it middle of May of 2026. And yeah, right now with the challenges and conflicts and headwinds, let's say that, and how the stock market has performed in the face of them, we are getting a lot of interesting questions as it relates to the stock market and investing. The most common 3 and how I answer them, let's get into it. The number 1 investment question right now is the stock market expensive? Is it expensive? And I heard this one recently. I mean, yeah, it comes in, a few different shapes and sizes, but when's the stock market going to crash, right? I heard that one. It can't stay this high forever. And I get it. Yeah, the stock market thus far this year, in the face of a ton of uncertainty and challenges, has actually, at the time I'm recording, has performed above average. It surpassed expectations. And that's after surpassing average returns in 25, 24, and 2023. So how would I answer that? Number 1, I would say that in the short term, the stock market, tracking the stock market and how it performs, over a 1-year time period is like trying to track a leaf in a hurricane. There's just no way of knowing and charting out exactly where you think it's going to go or exactly where it will go. There are so many forces pushing and pulling at all times. And yet there is a lot of optimism right now with AI and economic activity that could be, creating more productivity, while at the same time, there's some significant headwinds and with gas prices and oil and conflicts and so on. And so I would first kind of take a step back to say, well, no one really knows where the stock market's going to go. And yet, to address the question, is the stock market expensive? The answer is yes, it is. If you look under the hood, you know that this is one of my favorite charts. This is the forward PE ratio. What's PE? This is price. So price of the S&P 500 compared to the projected or the forward earnings or profits. That's technically how companies are valued, is their earnings or their profits. So where's the price of the stock market compared to those expected earnings? You can see over here that what this chart is showing, going back 30 some years and showing the price compared to earnings of the overall stock market. You can see that 30-year average of 17.2. If you're a fan of this chart, by the way, I look at it, they update it frequently. That average has been going up, guys. It's very, very clear. Prices have been trending higher. But still, even with that, is the stock market expensive? So that average is around 17.2. Going back to those, looking at these high points in the late 90s, early 2000s, you see stocks were trading over 24 times forward earnings. That's expensive, right? That's expensive. Look at that low point in 2008 and 2012. Stocks were trading around 10 times. Yeah, that's cheap, right? That's cheap. Look at where we are right now. Right? We had a surge after COVID and all the money printing. Yep, stocks got expensive. It dropped very quickly in 2022 when stocks came back down to earth. And then, for the past year and change, the stock market, I would argue, just based on long-term averages, is expensive. Now, that doesn't necessarily mean the stock market is going to crash or, to address that question. But I would say, stocks aren't cheap right now. And while no one knows the future, certainly over the short term, I would brace yourself that, stock market's expensive. We could see some more volatility. Because if you click to the next page, this shows on the left and then the right that, yeah, based on these forward earnings, what tends to happen to the stock market a year later or 5 years later, that chart on the left, yeah, leaf in a hurricane. No matter if the stock market's trading high or low or whatever, it's pretty random dispersion of how the stock market returns over the next year. But over 5 years, you start to see a pattern. Now, that's not really a high concentration. It's not a high R squared there, guys, but you can still see a little bit of a pattern there. And yeah, when the stock market is valued this high, the 5-year average return tends to be below average. So I would just level set that, yeah, it does look like the stock market's expensive. That's not a reason to get out or panic or think the stock market's going to crash, but I would set expectations. We could see some more volatility. We could see lower than average returns over the foreseeable future. Second most common investment related question is, how should I invest when I'm getting ready to retire? Fantastic question. One of the most important investment decisions, financial decisions you're going to make in your life. We've created a lot of content right here on this channel to help you with this very question. At a high level, we recommend a personal pension plan. When you're getting ready to retire, or you're just, within a couple of years of retirement or in retirement, taking an investment approach of when are you going to need the money, a buckets of money approach. There's a lot of different ways to say it. We call it personal pension plan, where you take a look at your retirement plan and say, well, how much money are we going to be withdrawing over the next 2 to 3 years? Well, that money shouldn't be high risk. It should be low risk. And so you've got a calculated amount of secure, stable, interest earning investments that will be able to provide you with steady income for the first 2 to 3 years of retirement. After that, the next 5 to 7 years of retirement, those should be in medium. That's that second bucket, sort of medium risk investments. Typically, strategies within this bucket are investments that do have some upside participation, but have some defined downside protection. This is a great spot for hedging or maybe some laddered investment strategies. That's the 5 to 7 years. So what you just did with those first two buckets, those first two components of your personal pension plan, is you've created confidence in your income stream, or where you're going to withdraw dollars from, no matter if the stock market surges or goes straight down. It's then the dollars that you're not going to touch for 8 to 10 plus years. Those are the dollars that are invested in a diversified portfolio, still for your overall risk tolerance, but those are the dollars that you want to go up and down to fight inflation over the long term, because you've got that clarity and confidence built out in the first two buckets. So personal pension plan, stratifying your investment structure for when you're going to need the dollars. That's the right way. That's the wise way to invest as you are about to retire. Work with your certified financial planner on that. And then the third most common investment question, should I still hold bonds? And fabulous question, and we've addressed it lots of times right here on this channel. Is the 60-40 portfolio dead? What are some bond alternatives? And for good reason, right? Bonds are supposed to be that diversifier, that steady and predictable, just paying you some interest. So as you get closer to retirement, reduce risk by reducing your stocks and adding more bonds. Guys, the past 5 years, past 10 years, that has not worked. That has not worked. And as we've seen inflation, but also as we've seen bonds not keep up with inflation, it feels awful. It has been an awful time period for bonds. I wouldn't say, well, based on what's happened over the past 5 to 10 years, that's what's going to happen in the future, and therefore you shouldn't own bonds ever again. But I would look at adding some diversification. And I don't mean adding multiple bond funds. I'm thinking of bond alternatives. Should you continue to own bonds solely, or should you own some other fixed instruments or other hedging strategies for your specific goals? This question I would answer in general, yeah, I would look at alternatives, but I wouldn't say, no, avoid bonds, don't hold any bonds. I would look at alternatives, and you've got to determine, working with your certified financial planner, whether that's appropriate and what types of alternatives you should use to complement your bonds or to replace the bond holdings that you have. So those are the 3 most common investment related questions that we're getting. Did I answer your question? Do you have an investment related question? Would love to see it down below in the comments, and we'll answer it on an upcoming video. Work with your certified financial planner, whether it's working through these questions or the specific, the investment strategy specific questions that you have related to your portfolio, your financial goals. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.